Hello and welcome to Commodities. I'm Lindsay Biscaya filling in for Andrew Bell today. Let's take a look at how some key commodities are trading today. We'll start with energy prices. You can see the price of oil, gasoline, natural gas all falling. Oil in particular falling today by more than 2% as investors weigh a potential peace deal in Ukraine, between Ukraine and Russia. And you can see gasoline prices down more than a percentage point at 1.3%, reflecting those lower oil prices after that capture as well of Venezuelan President Nicolas Maduro. That's definitely affecting oil prices today and gasoline prices. And we'll be checking in on that and following up on that throughout this half hour. In the meantime, though, here's a look at where some of the metals are trading today. Gold, silver, and copper. Copper, the really interesting story, up more than a percentage point, surging to fresh highs this week as investors bet on a tighter supply and potential tariffs from the U.S. this summer on unrefined copper. So we saw copper pushing past that $13,000 a ton benchmark, and gold and silver continuing to trade up today. Silver in particular up almost 5% at the moment, and we'll continue to dig into that as well. In the meantime, here's some of the stories we're watching today. Shares of gold reserve are up. The miner is seeking to regain control of its assets after the regime change in Venezuela. The company operated gold and copper deposits, which were seized by Venezuela's government. In an interview with Bloomberg News, Gold Reserve says it is already exploring deals that could help develop the deposits under a new regime. And Bloomberg is reporting Chevron ships are sailing to Venezuela. The energy company is the only Western firm allowed to produce and export crude oil amid American sanctions. According to data compiled by Bloomberg, at least 11 ships are scheduled to arrive at ports controlled by the Venezuelan government this month. Vessel movements tracked by Bloomberg shows one vessel is already loaded and two others are currently docked. All the oil goes to refineries in the U.S. And shares of Suncor are rising today as well. The energy giant says it has achieved its production targets 1 year earlier than planned. The Calgary-based company says that was driven by record production in the fourth quarter of last year, as well as its best ever annual upstream production, refining, and utilization. After coming off a massive year for mining and metals, we continue to see precious metals hit record highs this week. However, as AI demand and deglobalization continue, the 2026 market could look markedly different. For more on that, we're joined now by Helen Amos, Managing Director and Commodities Analyst at BMO. It's good to have you join us. Thanks so much for taking the time.
Good afternoon, and thanks for having me.
So just before we look ahead to 2026, we did see that growth of gold, silver, platinum, even huge growth in 2025. What are some of those factors behind that upswing that you think might carry over into 2026?
Yeah, look, it really is an incredible time for metals. 2025 was already a spectacular year for our space. We saw returns of 60 to 150% in precious. Copper itself was up 40%. And this year so far, already off to a very strong start. So silver, platinum, and copper are very much leading the pack so far. But what's more, we don't think this cycle is close to being over. So we actually see further upside across most of the major metals for into 2026. But our most preferred metals, they have the strongest fundamental story. That's copper, aluminium, and gold. And not just the strongest fundamental stories, but new money pouring into the space. So we're suggesting to clients it's far too soon to fade this rally. And of the drivers, it's the macro drivers like the weakening US dollar, strong emerging market demand, deglobalization, but also the very strong micro stories that we're seeing for particular metals, particularly copper.
Yeah, let's talk a little bit more about copper, because that's been an interesting one. We're seeing it this week, reaching new record highs once again. I take it you obviously expect that to continue into 2026. You went through some of those kind of key factors that were driving things into 2026. Does that apply to copper in terms of what's driving that price higher? Is it mostly supply and demand issues?
Yeah, absolutely. Look, copper's got a great demand story. It feeds into lots of end-use applications for future-facing sectors. So renewables, grid, data centers, defense, feeds into reshoring of manufacturing demand, but also strong emerging market demand, particularly India. But also not just that, but we're really seeing these like frictions in the supply base starting to come to the fore. We've had some major mines come offline or reduce production. So at the end of the day, it's very difficult to bring new supply online. So I think we've got a really good story for copper into next year. The other thing that's particularly affecting copper is that we're seeing this really big inventory builds taking place in the US. This is driven on by anticipation of future import tariffs, still very uncertain. But at the moment, the inventory levels of copper keep rising. And really, as long as we've got this prospect of import tariffs, we don't see an end to this. And that's basically drying up liquidity inventory in the rest of the world and keeping prices very well underpinned.
Yeah, I just want to touch on that in terms of how the prospect of potential tariffs are affecting the price of copper, right? Because there's that review coming up in the summer where the U.S. might reinstate those tariffs on copper. What's happening now? Is there a rush to get more copper into the U.S. because there's a potential tariff coming?
Yes, absolutely. So the tariff is not in place yet on refined. The recommendation from the government has been that from only 2027, there should be a 15% import tariff on refined. However, the expectation of that tariff in the future is already being reflected in the difference in the price between the US price and the rest of the world price, and that is resulting in a profit opportunity. Physical traders are bringing metal into the US, and as I said, that's continuing the dynamic from here.
You touched on this a little bit, but we're also seeing that AI advancement closely linked to the mining and metals sector, right? The equipment needed for a lot of data centers, for example, uses a lot of copper, a lot of silver. Is that going to be something that affects the price of some metals heading into 2026 as well?
Yeah, absolutely. I mean, look, data centers themselves might today only be like a small share of global demand. So some people estimate copper data center demand directly is only maybe 1% today. But the fact is it's keeping money flowing into the space. So it's bringing generalists into metals and mining. There's a very strong story. Obviously, ahead of us, we've got a strong pipeline of data centers that are still being built out. So I think it's definitely keeping generalists and money in the space, and it's contributing to a strong supply-demand story as well. We're certainly not seeing any upside surprises to supply. And really, when we're looking at the landscape for demand, all we're seeing is new applications. And so that, benefits copper, it benefits aluminium. As you said, it benefits the likes of silver and other critical minerals too.
And as you've outlined in your 2026 report, iron ore could be a solid investment this year. Why do you think iron is being overlooked, and what's driving your optimism around that metal?
Yes, so iron ore is eternally the overlooked metal. I would say there's this very bearish narrative that has been in the mainstream on the commodity for many years now. But it's also a commodity where consensus has been consistently too conservative. So we've done a lot of work on iron ore actually showing that really it's much less about the demand side. So sure, iron ore might not be the commodity that benefits so directly as copper from like AI, say, and grid and data centers, but really it's got very, very favorable supply side characteristics. It's a very consolidated industry, so there are a few industry players, and what we're seeing essentially is capex discipline or restraint. So that's keeping prices well above the cost curve, and it's a very efficient market as well. So it's got a steep cost curve tail. So when prices do wobble around, you tend to see marginal supply exit very quickly. So for us, we're also in a very good seasonal sweet spot for iron ore this current quarter, and also some of the other steelmaking raw materials like met coal. So we're actually highlighting to clients that this could be like a little bit of a surprise into this year.
Very interesting and definitely something to watch for. Okay, that's all the time we have, but appreciate you joining us today and sharing your insight. Thanks so much.
Thank you.
That's Helen Amos, Managing Director and Commodities Analyst at BMO. Up next, we are watching the price of oil, which is sliding today as investors consider the potential impact of Maduro's ousting on the Venezuelan oil market. We'll be back with more on that in a moment. Oil Oil prices are dropping today despite concerns about a potential shortage of Venezuelan crude supply. Our next guest notes that while the removal of Nicolas Maduro from Venezuela could increase that country's oil availability, the extent and timing of any price impact is unclear and will depend on U.S. policy. For more on this, let's bring in Eric Lee, global energy strategist at Citi. It's good to have you join us. Thanks so much for taking the time.
Hi, good to be here.
So there was some thought that maybe we would see higher crude prices given what's going on in Venezuela. What are you seeing? I mean, given what we're seeing today with the price of oil, is any of this a surprise to you?
I mean, there's still a good amount of uncertainty going on. I mean, on one hand, in the near term, you have still questions about U.S. sanctions on Venezuela, on some of the blockade, on the crude oil getting out of the country, how much is getting to China, et cetera. And then you've got the questions about, what this might mean short term and longer term for other geopolitical flashpoints that might affect the oil from Israel, Iran to Russia, Ukraine. So I think that's in the backdrop. On the other hand, we are seeing, questions about, what it means if and as Venezuelan oil reserves are developed further. Can Venezuelan oil production recover in the near term, and then can it actually grow significantly in the longer term? So there's definitely a range of issues that we're kind of looking at the minute. And the big backdrop is, of course, that even for the past months, a lot of us have seen that 2026 could be quite an oversupplied year for oil, and that OPEC Plus might need still to manage the market going forward. So a lot of moving parts here.
Lots of moving parts. I want to get to that oversupply component in just a moment. But first of all, your base case is assuming that Venezuelan output will begin increasing in the fourth quarter of 2026. Are there some key factors that have to kind of align here to see that happen, to see Venezuela's oil industry kind of revamp?
Yeah, definitely. I mean, some of the issues are short term. I mean, what is going to be the nature of the Venezuelan government going forward and U.S.-Venezuela relations, and will sanctions and blockades kind of be lifted. There's a possibility for short-term recovery of production. We've noted about 500,000 barrels a day potentially, order of magnitude, a lot of uncertainty, but starting to grow from perhaps the fourth quarter of this year through to the fourth quarter of next year. Now, these are things that we have to pencil in. Again, a lot of uncertainty, but we see that short-term upside, and some, heavier, sour crude oil kind of coming back to the market here. Longer term, we've said that, here you might need on the order of $100 billion of more sustained investment of, up to a decade before you could see Venezuela getting back to historic highs of, it was once at 3.5 million barrels a day of production. That would be a longer road in our view.
That's the long-term kind of thing. Okay. When it comes to U.S. oil companies potentially investing in Venezuela, do you expect that to be happening at the level the market anticipates at this point?
Well, I mean, I guess there's a question as to what the market is anticipating. I mean, on one hand, there's clearly a big rhetorical push from the White House to get U.S. oil companies really into Venezuela. Of course, some are already active. Chevron remains one of the sort of few sole companies that has a U.S. government waiver to continue operating, even recently under the recent pressure. But there'll be a lot of questions. I mean, on one hand, yes, for sure, there are significant, huge reserves of particularly extra heavy oil in the Orinoco Basin. So if that were developed, that would be very significant. On the other hand, there's a lot of old infrastructure. The governance, I think, is going to be a very and fiscal regime. How are revenues split? All of these kind of questions, security situations, stability of governance. That all kind of need to be part of every company's decision-making process for whether to do this. And then in the backdrop, of course, there are alternatives. There are investment opportunities in other places. And then at the base of it, what are the economics? What is the oil price? And the oil price itself is not particularly high. I mean, as we've forecasted over the past year, prices have come down to Brent at $60. And this is a moderately low price. It's not super low, but it's moderately low. And that may also stimulate sort of exuberance to invest heavily in new supply as well. As mentioned, 2026 is kind of an oversupplied year in our and many people's views. 2027 could still be oversupplied.
You mentioned those falling prices as well when it comes to oil. What do you expect from OPEC plus producers this year, given those falling prices, given what's happening in Venezuela? Do you expect maybe greater production discipline this year from members?
Well, we already, as mentioned in our annual outlook, which we put out a few weeks ago, that something might change in Venezuela and that production might rise in Venezuela, and that oversupply in 2026 could be quite substantial. However, we were also seeing factors that would support the oil price in more of a range of $55 to $65 Brent. So one of those is actually strong Chinese buying continuing, so stockpiling for strategic reserve. That's something that continues in the background. But then importantly, OPEC Plus. There are a few different views on this. Our base case is that OPEC Plus will continue to pause its unwinds of its oil production cuts, as they've done so for the first quarter of 2026. But we see that in our base case stretching out through 2026 and into 27. They may even be more active to support the $55 to $60 view, in our base case. And if they do that, then I think that's going to be one of the things that helps support this price. Another one is ongoing geopolitics. The bear case and bear scenario there is that OPEC Plus, and in particular Saudi Arabia, may still continue to look at bringing more oil back. If there is some U.S.-Saudi alignment on keeping oil prices moderate or even getting them potentially lower, the White House may have an interest in that ahead of the midterms later this year, then that could mean that oil prices could move lower if the U.S. and the Saudis have that preference.
Okay, just so much to watch for. That's all the time we have, but really appreciate you joining us. Thanks so much.
Thanks very much.
That's Eric Lee, global energy strategist at Citi. Up next, the ousting of Nicolas Maduro is raising concerns among Canadians about whether increased Venezuelan crude imports could impact Canada's oil sector. We've got more on that after the break. Welcome back. Our next guest is confident Venezuelan oil is not going to substitute Canadian oil at U.S. refineries, at least not in the short term, but could have a significant impact on Alberta's economy. For more, let's welcome Charles St-Arnaud, chief economist at Service Credit Union and former Bank of Canada economist. It's good to have you join us. Thanks so much.
Good afternoon.
So let's start. Why don't you think in the short term the Canadian oil market really has any concern?
Well, in some ways, this geography is in some ways, benefiting Canada. Is that when we look at Canada's oil exports, yes, more than 90% are going towards the U.S., but it's where in the U.S. they're going that is important, and whether or not they can be displaced by Venezuelan oil. So right now, about 70% of Canadian oil is being exported to the refineries in the Midwest. About another 10% is going to the Gulf Coast, and another 10% is going to the West Coast. And at the moment, the only place where Canadian oil could be displaced is really at the Gulf Coast, where the U.S. could import oil directly from Venezuela to use in those refineries. So that's about 10% of the Canadian exports. And that oil that arrives from the Gulf Coast cannot at the moment travel north toward the refineries of the Midwest, because currently the pipeline system is meant to bring actually Canadian oil from the Midwest to the Gulf Coast. And then when we look on the West Coast, the refineries, especially in Washington State, are actually being fed through a branch in the Trans Mountain system. So they actually have direct access to Canadian exports. So it will be very hard for Venezuelan oil to actually reach that region. So that means that in the very short term, only about 10% of Canadian oil exports could be affected by the increase of production in Venezuela.
When it comes to long term, though, what does that look like? Are you expecting more infrastructure to be built to get Venezuelan oil to those other areas of the U.S.?
Well, that's I would say the billion-dollar question is, one, are the U.S. Oil companies, will they be willing to invest massively in Venezuela to increase the production substantially? Because at the moment, Venezuela produces about 1 million barrels per day of oil versus Canada exporting 4.5 million barrel of oil to the U.S. So it's almost 5 times more exports from Canada than what Venezuela can produce right now. So they will need to ramp up that production to be able to displace more Canadian oil. Then from there, is there an incentive to actually bring that oil to the Midwest? Is the pricing is good? Is the investment in the pipeline infrastructure favorable enough to actually justify that investment? So that's why in the short term, it's very hard for Venezuelan oil to displace Canadian oil. In the long term, if the economic incentive are there, it's a possibility.
But even in the short term, I mean, you mentioned that 10% that could be replaced by Venezuelan oil going to the Gulf Coast. Like, is 10% a lot when it comes to the Canadian oil market? Like, could that do a lot of damage still to particularly Alberta?
Yeah, well, when we look at it in the grand scheme of things, it's about a value of a loss in terms of exports of about 13 billion. For Canada as a whole, it's not great, but it's still manageable. It's when it comes to Alberta, we're talking to almost a hit of about 3% of GDP. So that will have some very significant impact or some important impact on the economy. But the other impact also would be what happens to the oil price differential, where having that competition between Venezuelan oil and Canadian oil will likely lead to a wider discount on Canadian oil and will have an impact on pricing. And that will have, again, more impact on the economy, but also a lot of impact on the fiscal situation here in Alberta.
No kidding. And we've, of course, got the renegotiation of the free trade agreement coming up this year between Canada, the U.S. and Mexico. Oil for Canada was one of the big key components, one of the big leverages that Canada has in these trade agreements. How might what's happening right now between Venezuela and the U.S. affect that in terms of Canada having something to offer?
Yeah, well, it changed, but only at the margin the leverage Canada has. I think now the U.S. can really play the card that, hey, we have access to all those reserves, so we don't really need Canada. But in some ways, the Canadian government can actually call in some way that bluff, because the U.S. will require immense investment in Venezuela to actually increase production enough to displace Canadian oil. So, and that's not a guarantee yet. And we also have to keep in mind that the more we produce that oil in Venezuela, the more likely we'll continue to contribute to the current oversupply in oil that will probably last for longer than what is expected. So with those low oil prices, will the financial incentive of actually producing more and committing more investment money long-term will make sense for the big American companies.
A lot to watch for. That's all the time we have, but appreciate you coming on and sharing your insight. Thanks so much for your time.
Thank you for having me.
That was Charles St. Arnaud, Chief Economist at Service Credit Union and former Bank of Canada economist. And thanks for watching Commodities today. If you have a story idea, you can always email your story ideas to commodities@bnnbloomberg.ca.